When you buy an electronic product like a phone, laptop, television, or even a machine, a warranty comes with it most of the time, where you can approach the seller for free repair or replacement if the product malfunctions due to no fault of yours during the warranty period. As a consumer, we like it when the seller provides a warranty. Let's see this from the seller's point of view. In other words, how is warranty accounted for? When should warranty be recognized and how much warranty should be recognized? This brings us to the topic of FRS 37, Provisions and Contingent Liabilities. A provision is a liability of uncertain timing or amount. We have learned about payables and accrued expenses in previous videos. Both are liabilities, as we know. So how are provisions different from payables or accrued expenses? In the case of payables and accrued expenses, the goods or services have been received or supplied. So the difference between the two is whether the amount is invoiced with the supplier. Although it is necessary to estimate the amount or timing of accrued expenses, the uncertainty is generally much less than for provisions. FRS 37, paragraph 14 states 3 criterion to recognize a provision. A provision shall be recognized when the entity has a present obligation, be it a legal one or a constructive one, due to a past event. When it is probable that an outflow of resources will be required to settle the obligation, and when a reliable estimate can be made of the amount of the obligation. All 3 criterion must be met before an entity will recognize a provision. If even one criteria is not met, a provision is not recognized. To answer the first criteria, something must have happened, holding the entity responsible for an obligation. This is called an obligating event, where the entity must settle the obligation. Such obligating events can be further classified into 2 categories: an obligation enforceable by law through contracts or legislation, and a constructive obligation, which is an obligation arising because an entity is involved in an event which creates valid expectations in other parties that the entity will discharge the obligation. This often arises due to established patterns of past practices, published policy, or a sufficiently specific current statement the entity has indicated to other parties that it will accept certain responsibilities. Please note that if an obligation will arise due to future planned actions, this is not recognized as a provision, because the entity can change its plan and avoid the obligation. One common example is restructuring, which is a future program planned and controlled by management to change the scope of business or the manner in which the business is conducted. Criteria 2. Is it probable that an outflow of resources is needed to settle the obligation? The answer is yes if the probability that an outflow will occur is higher than the probability that no outflow will occur. If the probability that an outflow will occur is more than 50%, it is considered probable. Third criteria. Can a reliable estimate be made of the amount of the obligation? Most of the time, the entity can determine a range of possible outcomes and estimate the obligation that is sufficiently reliable to use in recognizing a provision. This involves judgment. But what's important is that the entity base their estimation on reliable grounds. Let's go back to the example at the start of this video, warranty. So let's assume the company sold 10,000 gadgets this year. It comes with a 2-year warranty to replace the gadget for free should it malfunction. Around 1% of gadgets sold malfunction within the warranty period. It costs $170 to manufacture a gadget. Should a provision be recognized? Let's go through all 3 criterion. First, does the entity has a present obligation due to a past event? Yes. When the entity sold the gadget, it comes with a warranty to replace the gadget should it malfunction within the warranty period. It has to fulfill the obligation should the customer approach the entity for warranty claim. This obligation arises the moment the entity sold the gadget. Second, is it probable that an outflow of resources is needed to settle the obligation? It may be tempting to say no because the malfunction rate is 1% and the likelihood of outflow for any one item may be small. However, in the case of warranty claims, where there are many similar obligations, The probability that an outflow will be required in settlement is determined by considering the class of obligations as a whole. With 10,000 gadgets being sold and a 1% malfunction rate, the overall probability that the company will see a warranty claim is very high. You can do the math if you want to. Third criteria: can a reliable estimate be made of the amount of the obligation? Here, we need to come up with an expected warranty claim figure based on reliable grounds. If the company sells 10,000 gadgets and 1% of it malfunctions, we expect that maybe around 100 of them will malfunction. If the cost of manufacturing the gadget is $170, that is the cost incurred by the company to replace the malfunction gadget. So the estimated value of the obligation is $17,000. The actual warranty claim may be more or less than that, but this is a good estimate of warranty claim based on information we know. All three criteria are met, so we need to recognize the provision. The journal entry to record estimated obligation at the end of the financial period is to debit expense and credit provision. When the entity sees an actual outflow of resources to settle the obligation, it debits provision and credit cash. For the case of warranty claim, you will credit inventory instead because the company compensates the customer with another inventory rather than paying them cash. Now, I need to caution you about the first journal entry because it may be quite confusing or even misleading. If the provision is on a recurring nature, for example, warranty, you enter the first journal entry to make the provision balance equal to the estimated obligation at the end of the financial period. To illustrate what I mean, let's assume that the provision for warranty balance is $100,000. The actual outflow of resources is $90,000. Estimated obligation at year end, $120,000. First, we debit provision for warranty and credit inventory by $90,000 to recognize the actual outflow of resources. The journal entry for year end is debit warranty expense and credit provision for warranty. But by how much? Is it $120,000? No. You debit warranty expense and credit provision for warranty to make the provision for warranty balance equal to the estimated obligation at year end. So that means we want the ending provision for warranty balance to be $120,000. The first journal entry reduces the balance by $90,000 to $10,000. So to increase it to $120,000, the figure for the entry will be $110,000. Besides warranty, some other common provisions include lawsuit claims, audit fees, and tax, given their uncertain nature. Let's now cover contingent liabilities. A contingent liability is a possible obligation that arises from past events and the existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future activities not within the control of the entity. It could also be a present obligation arising from past event, but it is not probable that an outflow of resources is required to settle the obligation. Similarly, the amount of the obligation may not be measured with sufficient reliability. A contingent liability is only disclosed in the notes to the financial statement. It is not recognized in the financial statement directly. However, if the possibility of an outflow of resources is extremely low, the entity is not required to disclose the liability in the notes. Do you remember the three criteria for recognizing a provision? I mentioned that all three criteria must be met before a provision is recognized. So if one or more criterion is not met, we will disclose it as a contingent liability in the notes to the financial statements, unless the possibility that an outflow of resources is extremely low. Putting it into a Venn diagram form, the main difference is that a provision is a liability that is certain. The entity is pretty much certain that it has an obligation. A contingent liability is even more uncertain than a provision in the sense that the entity doesn't even know whether it has incurred an obligation, or the amount cannot be reliably estimated at all.